Every financial system in history has had a moment like this, a moment when everything still appears stable on the surface. But deep beneath the structure, something fundamental has already started to break. For the Roman Empire, it was a silent debasement of silver coins. For the Spanish Empire, it was a flood of silver that quietly destroyed the value of money. For the British Empire, it was a massive debt accumulated during 2 world wars. And today, some economists believe that a similar pressure point may exist inside one of the world's most stable economies, Japan. For decades, Japan has been viewed as a symbol of economic discipline, a technologically advanced nation, one of the richest countries on earth, a pillar of the global financial system. But beneath that reputation lies one of the most extraordinary financial experiments ever attempted in modern history. Because Japan holds the largest government debt the world has ever seen, more than $20 trillion, a number so large it exceeds the size of many entire economies. And yet, despite this massive burden, the system has remained stable for decades. The question is, how? To understand why Japan's situation is so unusual, we need to understand something fundamental about financial cycles. Throughout history, economies tend to follow similar patterns. First comes growth. A nation expands its economy, increases productivity, and builds wealth. Trade expands. Industry grows. Confidence rises. This is the stage when financial systems appear strongest. But growth often brings a hidden temptation. Debt. Borrowing allows governments to accelerate development. It allows them to finance infrastructure, support industries, and maintain social stability. For a time, this works remarkably well. Debt fuels expansion. Expansion creates prosperity, and prosperity reinforces confidence. But the cycle rarely stops there. As economies mature, governments often begin borrowing more than their systems can comfortably support. Spending grows faster than revenues. Deficits accumulate, and gradually, the financial structure becomes more fragile. This pattern has repeated across centuries, from ancient empires to modern financial powers. But Japan's case is unique in one crucial way. Instead of allowing interest rates to rise naturally, Japan attempted something unprecedented. The country's central bank began purchasing enormous amounts of government debt, trillions of dollars worth. In effect, the Bank of Japan became the largest buyer of its own government's bonds. This policy was designed to solve a very specific problem. For decades, Japan struggled with extremely low economic growth. Inflation remained weak, consumer spending slowed, and the economy entered a long period known as stagnation. To stimulate growth, the Bank of Japan adopted aggressive monetary policies. Interest rates were pushed near zero, and eventually, the central bank began creating money to buy government bonds directly. This approach kept borrowing costs extremely low, which meant Japan could continue carrying massive levels of debt without triggering a financial crisis, at least for a while, because there is an important rule in financial systems. Low interest rates make large debts manageable, but rising interest rates can quickly transform manageable debt into something much more dangerous. And in recent years, the global financial environment has started to change. After more than a decade of extremely cheap money, central banks around the world began raising interest rates. Inflation surged, borrowing costs increased, and global capital began moving again. For Japan, this shift created a delicate situation, because when a country carries debt equal to more than 250% of its GDP, even small changes in interest rates can have enormous consequences. A tiny increase in borrowing costs can translate into hundreds of billions in additional financial pressure. This is where the system becomes fragile, not because collapse is inevitable, but because the margin for error becomes extremely small. And Japan is not just any economy. It is one of the largest financial investors in the world. Japanese banks, insurance companies, and pension funds hold massive portfolios of global assets. Trillions of dollars invested in foreign bonds, equities, and financial markets. If Japan's domestic financial conditions change dramatically, those institutions may need to rebalance their portfolios, which means selling assets. And when large institutions sell assets quickly, global markets feel the shock. This is why analysts sometimes refer to Japan as a potential trigger point in the global financial system, not because Japan itself is weak, but because its financial structure is so enormous that even small shifts can ripple across global markets. History shows that financial transitions rarely begin with obvious crises. Instead, they start quietly. Interest rates shift, confidence adjusts, capital flows begin moving in new directions, and slowly, the structure that once appeared stable begins adapting to new conditions. The Roman Empire did not collapse overnight. Its financial system weakened gradually over decades. The British pound did not lose its global dominance in a single moment. The transition unfolded over years. Financial systems change slowly, until they suddenly accelerate. Japan may not be on the verge of collapse, but the scale of its financial experiment is unprecedented. A debt structure exceeding $20 trillion, sustained by one of the most aggressive monetary policies ever implemented. And history teaches us that systems built on massive debt eventually reach a critical phase. A phase where confidence, policy, and economic reality begin to interact in unpredictable ways. Sometimes the system stabilizes, sometimes it restructures, and sometimes a new financial order begins to emerge. Because throughout history, economic power has never remained fixed forever. Empires rise, financial systems evolve, currencies gain dominance, and eventually lose it. And behind every major shift in global power, there's almost always the same underlying force: debt, a tool capable of building extraordinary prosperity, but also a force capable of reshaping the entire financial world. And as history repeatedly shows, no financial system escapes the cycle.